All right, welcome today, everybody. Thank you so much for joining us. My name is Maureen Rice. I use she, her pronouns. I am the Program and Marketing Associate for the Woodby Community Foundation. We're very excited to have everyone join us today for building an effective nonprofit budget. This workshop was brought to you in partnership by 501 Commons, who will be facilitating today, Snow Isle Libraries, and the Woodby Community Foundation. We do plan on recording today's webinar, as I mentioned, so please feel free to leave early if you need to or hop in late, and we'll make sure everybody gets a copy of this, as well as the slides and resources that Susan was kind enough to provide for us. I would just quickly like to highlight a few other items on behalf of the foundation. We do encourage you to look through our nonprofit services and resources, which I will provide a link to in the chat. These include our nonprofit directory, where your organization can claim its profile and update the community on your upcoming events, open volunteer positions, and open jobs. We also have our nonprofit community Slack for Whidbey Island specifically, which now has over 130 local members. This is a great place to talk to your local colleagues. We also want to mention a few upcoming events. This next Friday at the Coupeville Library on June 6th, we'll be hosting a grant writing training in person, and we do have a few other upcoming events through June and September. I'll include a link to those as well in the chat. I'd love to turn it over to our presenter, Susan Davis, and let her introduce herself. We're excited to see everyone today.
Thank you, Maureen. Good to see you all. And I'm also joined by my colleague, Jan, who is the program manager of our management consulting program. A little bit about 501, actually, just stick on the intro for a minute. Yeah. So 501 Commons, for those of you who aren't aware, we're a nonprofit that supports other nonprofits with their capacity building. We provide training such as this and on a range of other topics, and we also provide various kinds of services for a fee to other nonprofits. So in the financial services program in particular, that means we have a team of bookkeepers and accountants who are providing monthly bookkeeping, 990 form preparation, and other financial management support around the country, but most of our clients really are based, the nonprofits we work with are based in the Pacific Northwest and Greater King County area. So a little bit about me. I bring a
Susie,
few,
here.
oh, and maybe just keep yourself muted for now unless we're in a question answer section. Um, a little bit about me. I bring a couple of different perspectives to this topic. Aside from my work at 501 Commons, where I've been for about 4 years, I've worked both in nonprofits and for-profit businesses throughout my professional career. I owned a small clothing manufacturing business for many years and was basically the finance department. um, and I also worked at Seattle Opera, where I managed one of the programs there, which included extensive budgeting and forecasting, often on a weekly basis. So, very familiar with the topic. Let's see. I was going to ask for a show of hands about who's familiar with 501 Commons or heard of us before, but I know all of you don't have um, your cameras on, which is fine. You could do a little thumbs up in the reaction bar if you would like, um, if you've worked with us before. And oh, great, a few thumbs up there. And how many of you have are new to budgeting in your role that you're in right now? All right, just a couple maybe. And how many of you have a pretty good budgeting process, but maybe you're just here to learn one little tip or get a reminder of something that you need to be doing that maybe keeps getting on the back burner? All right, also a couple of thumbs up there. So I'm really here to take some of the mystery out of budgeting and make it approachable, just remind you of the importance and maybe give you a tool that you didn't have before. So next slide. So just the agenda for what I'm going to cover. I'm going to talk about the purpose of the budget, go over the budgeting process, different steps in that. Then I'm really going to go in depth about developing the budget, actually generating the numbers that become what your budget is. I'll do a review of the basic financial statements that you should be reviewing regularly and have time for questions and hopefully answers at the end. But also, if you have questions as we go, you could drop them in the chat, or even really, I think we're a small enough group, you could unmute yourself and ask your question. So, because I don't want to move on and lose you if I've haven't been as clear as I could be on one of the topics as we move along. Next slide, Jan. So, what is a budget that we're talking about? It's in sort of the not just the numbers, but it's, a guide for the future, a roadmap, where are we going and how are we going to get there? It's a planning and a communication tool. How are we going to achieve our mission? What are our priorities for the coming year? It's also a financial management tool, a way to measure and monitor your progress throughout the year and compare your actual performance against the plan, and possibly and very often adjust your plan as needed. You don't necessarily adjust your budget, but you do adjust your plan, and we'll talk more about that later also. It's great to have an ambitious budget, but it also needs to be realistic and backed by assumptions that you've written down so you can reference those when you're looking over your budget. What it's not is, a one-time process, oh, we just do budgeting in October and then it's done. No, it really should be part of and incorporated into how you're managing your finances throughout the year and really incorporated into your ongoing financial management. Next slide. So I'm really going to be talking primarily about your operating budget. So your projected revenue and expenses for a fiscal year. How are you going to get the money, whether it's earned or unearned, and where are you spending the money for a fiscal year, which for many organizations is January through December, but there's certainly um, other fiscal years. July through June is a pretty common one, and then there are lots of other variations through the year. We also might call the operating budget the annual budget, or honestly, just the budget. And most of us know what we're talking about. Depending on the size of your organization and the complexity of your budgets, there will be a few, if not many, sub-budgets that roll into the numbers that generate your annual budget. And it really doesn't need to be balanced. We have this idea of thinking about a balanced budget, but and we hear that talked about, at the government level and personal family budgets and so on. But there are lots of reasons why your budget may have cash left over with your income less your expenses. There might be a positive balance at the bottom. There might be a negative balance. Neither one is right or wrong. It really just depends on the circumstances of your organization. And just to say a little more about that, if you have money left over, if your income for a year is greater than your expenses, there are likely other uses you have for that cash that's left, so-called leftover, or what they would call profit in the for-profit world. And I will talk about those more. That might be a reserves budget or capital spending plan. And likewise, you might have a negative balance. And that doesn't mean you don't have money in the bank. It means that maybe you got some funding in the prior year that was earmarked to spend in the current year, and and you'll be using it, in the coming year. Next slide. So I have to get to my notes, next slide notes too. So the basic steps, which I'm going to talk more, which you see here on the slide. First is to assemble your team. Who are the people in your organization that are going to be helping with the budget. Um, it's great to designate somebody as the leader of the team who's really a champion of the process. And the main idea, I know some of you, I can't see all your faces, but you're probably thinking, like, what does she mean team? It's just me and my board treasurer or something. It might be a team of two, but the idea of the team is to make sure that you're really including all the perspectives. So the perspective of the executive director, of course, of somebody in a chief financial operator, CFO role. Um, HR has a perspective to do with wages and benefit costs and so on. Your program manager or department heads have a perspective about what the costs are associated with providing the programs and services that you're offering. Your development director has a perspective about where money can be raised from and maybe what some new funding sources are. And then, of course, your board and your board finance committee in particular want to be involved to make sure that your budget reflects and supports your mission and the activities of the nonprofit. So that's just a little bit about assembling the team. In terms of creating a calendar, I worked in theater for many years, and we always started with, opening night and then worked backwards so that we knew that all the work we needed to do to get to opening night, we actually had scheduled enough time to do that work. And so likewise, we know with the budget, there's some day by which we want the board to approve the budget. So you might start with that day and then think about, when your board meetings are or when the finance committee meeting is and so on, and create internal deadlines for, okay, if we want to have the board be able to review a draft budget in late October, then we need to start our work in September or early October. You'll know, again, knowing the activities of your own organization and what else you're working around. But it's great to have a calendar in place where you keep the same schedule every year, put it on your calendar, the board's calendar, your staff's calendar, if there are any staff people that are involved in helping generate information for the budget, so that next year when the process time comes around again, they're nobody's surprised. They know that this is going to also land on their plate along with what they think of as their actual job. It's not, it's can be easy to think of it as sort of extra work, but it's really integral work to the managing of an organization. So then preparing for the process has to do with articulating what the goals are for the organization, what program goals you have, or what projects you're going to be providing for the year, what the financial goals are, if you have any reserve goals or capital purchase goals, and just thinking about all the things that you want to do for your organization and in service of your mission for the coming year. You also want to, in preparation, look at historic data and maybe trends over the past few years, and document your assumptions of what you imagine is going to happen next year based on what's going on this year and prior years. And how far you go back really depends on, is your organization consistent in the services or programs it provides? Then maybe looking back further is more useful. If things are more fluid and sort of change over time, might not be as meaningful. At this point, when you've got all your information together, you've got your calendar, you know who your team is, then you really want to have a kickoff meeting and get everyone on the same page to start the process. Because then everyone's work is going to be developing their portion of the budget. So coming up with the actual dollar amounts that align with each of your revenue sources and your expense lines. And I'm going to really dive into that in a little bit later. But first, really work through those 3 steps, the first 3 steps, so everyone knows what their part is. They know what the schedule is. Everyone's agreed upon that. And always make sure you've allowed time for some revisions in there. And then the last piece is really monitoring the budget. This happens, of course, after you have an approved budget. It has to do with reviewing your financial statements, looking at what you've budgeted versus what's actually happening on a regular basis, whether that's monthly, quarterly, weekly. It really depends on your work. It might be by project. Um, and when we review financial statements, I'll show some examples of looking at budget versus actuals. Are there any questions before we move on to developing the budget? And you can just unmute yourself if you have a question. All right, so moving on. There are different approaches to developing a budget. There is incremental budgeting, which is using the a budget that you already have from, say, this year or the prior year and adding a percentage of increase or decrease to each budget line. Or there's looking at your revenue first and your expenses second. What are our what kind of how much money can we generate, and then what can we purchase with that amount of money? What kind of the how many programs can we offer, or the extent of our programs or services? Or there's the other way around, looking at, okay, these are the um, looking at your expenses first. What are the programs and services that we want to offer to how many people and how many events and so on? And then what revenue do we need to support that level of programs? Or there's starting from scratch, which is also called zero-based budgeting. And that's really building a budget just from the ground up, line by line, going through funding sources and income generation, as well as expense projections. And this is typically um, more with newer organizations or new projects. You might be starting from scratch. But really, most of you, and certainly at 501 Commons, we are developing our budgets using a little bit of each of these methodologies. We might know um, that our rent is increasing by 4%, so we're just adding 4% to our rental line or something like that. So where to start? Next slide. So in your chart of accounts, you have your revenue and your expense lines, where the money comes from and where the money goes to. And for the purposes of um, the slides that I'm showing you, including the financial statements, um, they're pretty slimmed down to just a more simplified version. Otherwise, the screen would be a little overwhelming. If you have a software system that you use for bookkeeping, whether that's QuickBooks or one of the other programs, there's probably a budget overview report that from the previous year, which might be a good place to start. When you're planning and budgeting for the upcoming year, it's really a perfect time to review your chart of accounts and make sure you're actually uh, have all the revenue lines and the expense lines for all the items that you want to track. There might be new accounts that you need to add. There might be some old or unused accounts that can be deactivated. There might be duplicate accounts that you can merge. So part of your budgeting process is really useful to review your chart of accounts. Um, And a lot of folks do their budgeting in Excel spreadsheets, so there's not necessarily while there's a place to put a budget in your bookkeeping system, it's maybe not the best place to initiate your budgets. And one of the documents that I'm gonna that Maureen will share later is a budget, an Excel budget workbook that you could customize based on your own revenue and expense lines if you are interested in that. Um, and some organizations develop their budgets on the yearly basis, but then maybe they divide them into months so they can look at month by month. Some organizations develop their budgets by month and then roll it into the year. I find that can be it's a little challenging to do it that way. I prefer starting with a year and then breaking it out by month, certainly for the purposes of analyzing cash flow, which again I'll be talking about later. So thinking about the revenue side, and maybe I'll just pause if there's any questions yet. Very quiet group. All right. So developing the budget on the revenue side, you have two main categories of revenue, your unearned or contributed revenue, which might include grant revenue, annual appeal or fundraising revenue, monthly giving donations, your interest income, and then you have your earned revenue, and that might be program revenue or revenue from events or sales or possibly rental income. Um, and again, when you're starting to look at budgeting for your revenue, you want to make sure that you are accounting for all the sources of revenue that you have so that you're budgeting for those. And in as much detail as makes sense for your organization, but not so much detail that when you are, particularly if you're using a program like QuickBooks, you want to make sure that your financial reports, when you run them, don't have so many um, account lines that the reports are pages and pages long. It's very hard to understand what's happening in the organization. So there are ways of looking at the details that don't need to be broken out so specifically in your chart of accounts. Next slide. So when you're going through line by line in your revenue accounts, you basically are asking questions about each line, and also just generally, what was our revenue last year? Do we expect that to be the same or more or less? Do we expect to have the same sources of revenue? Have we identified any new sources? Um, You might be looking at your historic financial reports. What's been the change in revenue from year to year, or maybe the change in particular funding sources from year to year? And then also thinking about the other places that generate revenue. Maybe you have some programs that are for a fee. Are you going to be charging the same fees? Are you going to be raising your rates? So really looking at each of those revenue lines and then making sure you record your assumptions so that when the board member says, why are you forecasting double or budgeting double in this line from what we budgeted last year, you'll have an answer for them. Or hopefully you will. So here's just a sort of a summary of what your revenue budget proposal might look at, again, with a place to put assumptions. If this was a budget for your organization, you probably have an assumption in each beside each of those revenue sources to just even as a snapshot reminder of how you arrived that number. There might be some backup workbook that has even more information about your individual donors, say, but there might be just a brief assumption about how you derive that number. And let's see if there's anything else I want to say about that slide. I think that's it. So on the next slide, so this is, I wanted to just dive into what some details might look for, let's say, on your contributed revenue side. So this is a method for budgeting based on the likelihood your organization has of receiving a very particular donation. So this gets into the details of specific funders. So for example, under individual donors who give 250 and more and donors who donate less than $250. Um, the So actually looking down at the corporations section, so let's say you have 4 corporations who give money every year, and Corporation A has already confirmed that they're going to give you 15,000 for the next year. All these examples, by the way, are based on that we're in 2024 and we're budgeting for 2025. I realize that we are almost halfway through 2025, but imagine. Um, but maybe so they've confirmed you have a letter in hand where they've pledged to give that amount of money, then you're certainly in a great position to budget 100% of that money coming in. Where for Corporation C, maybe they give most of the time. I'll get to your question, Elizabeth. That's a great question. So let's say Corporation C has given 4 out of the past 5 years, and they've indicated that they're going to give for this next year, but they haven't said 100%. So you use this likelihood percentage, which, yes, is subjective. You are just deciding based on all the information you have on hand that you're going to budget 75% of that amount. So if you look over in the total to budget column for Corporation C, the budgeted amount is 5,500. So it's your best guess based on what you know at the time. So if you look at the foundations and grants section, grant C, let's say it's a new grant, you've never asked for this grant before, but it looks like, 80% overlap in what they're asking for and what you and your mission, like it's a good match. But because they've never funded you before, then you might budget for 25% of the grant amount that you're applying for. Did that answer your question, Elizabeth? I'm going to take that as a yes. Okay, great. Any questions about revenue before we move on to expenses? All right, so next slide. And so again, that actually just to say, you don't need to switch the slide back, Jan, but so that was just an example of, a backup spreadsheet that might help you generate the number that you're actually going to be moving forward on your budget. So similarly on the expense side, there are sort of 2 main types of expenses. You have your fixed costs, which are consistent from month to month. That might be some of your staff, some facilities costs, some administrative costs, maybe insurance, some of your contractors possibly. And then you have your variable costs, which depend on your programs and your fundraising activities. There still might be some staff expenses in there. Maybe you have some staff who are seasonal, for example. Just if you're providing summer programs, they come on in summer. The materials and supplies for those programs. your fundraising costs, maybe some equipment or maintenance costs, and some of your contractors, um, for example, for some infrequent activities like redesigning your website or something like that. Your fixed costs, for the most part, are your indirect costs, and the variable ones are your direct costs. And again, looking at all of your expense lines, make sure you're tracking the accounts that you have the accounts that you need in your chart of accounts, and you're tracking everything that you need to track in order to both um, um, report if you have to do any reporting to funders, for example, but also internally to assess the success of your programs. And what programs are maybe uh, generating or costing more than you had expected, and you can sort of analyze and make choices for next year. So next slide, just thinking about the questions to ask, similarly, both just some overview questions, but also line by line, what were our costs last year? So that's looking at your historic reports. What's our forecast for this year? How do we think we're going to end this year? And then we can apply that knowledge to budget for next year. If you have some planned salary or wage increases, then you can incorporate those. The person on the team who's wearing the HR hat on your budgeting team will be able to tell you what's happening with payroll taxes or with benefit costs if you have some benefits. Um, Will you have the same number of staff? Are you increasing staff? Are you offering the same programs and events? Are you adding programs? So a lot of these are really come into the assumptions piece, and then going line by line, just seeing where have we been with this expense and where do we expect to be going forward. So just looking at a summary on the next slide. So here's what a summary might look like, again, with some assumptions. Again, simplified for our purposes here. And I do want to point out right under the heading fiscal year 25 expense budget proposal, it says version 1, September 20th, 2024. You want to make sure that you're um, naming your budgets consistently across whomever is working on them so that you all are looking at the same information together that you need. You might be creating two budgets, one if you go in this direction and one if you go in that direction in some aspect of your organization. And you want to have them distinguished so that you're not confusing adding one piece of one budget to the other piece of the budget from the different scenario. I think I said that in kind of confusing way, but hopefully you got that. You just want to make sure you're all looking at the same document. It's easier when there are fewer people involved, but it can get more complicated if you have multiple people working on their piece of the budget. And so just keeping um, everyone using the same naming protocol will just simplify so many things, including, their file names, not just on the document, but on the file itself, if it's an Excel file. So going to the next slide, just a example of a detail that maybe you have a program director or program manager who is in charge of budgeting for the non non-staff expenses for their program. And that's often the case, I think, that where the supervisor is the one who's budgeting for the, for the staff, but then the person who's really running the program is maybe budgeting for the materials and supplies. So here's an example of having, three different programs. Maybe there's similar programs, but different times of year, and they serve a different number of people. And then what sort of, what expenses of different materials or supplies might be needed for those. So, any question on the expenses before we move on to this? All right. So this process includes developing the draft budget. And as I just mentioned before, make sure you establish a protocol for naming the versions of the budgets and documenting your assumptions. Um, Maybe this is the version with the added fall program, and this is the version without the added fall programs, because you might want to compare and see, can we be that ambitious? Can we raise the money to do this extra program? Um, when the budget is initially drafted, it'll be, sometimes there's an internal review process with the staff before it goes to the board. That really depends on the size of your organization and how many hands are involved in the work, um, in the budgeting work. Then there's presenting and reviewing it with the board, who's going to have questions. They might ask for some revisions. They might ask you to revisit some parts or to give a little more information on your assumptions. Then whomever's on the budgeting team will be developing the revised budget, present it and review it with the board. I mean, I make it sound so easy. I know it's not so easy, but at some point the board does approve the budget and then you're ready to go on to the next steps. So I want to take just a little side road here to other types of budgets because I've really just been talking about the operating budget, which is the heart of your budget, money, your revenue streams, and your expense lines. And but other budgets that relate to the operating budget include a capital budget, a contingency or reserves budget, and a cash budget, which is also called cash flow projection. So the capital budget and the contingency and reserves budgets really relate to your statement of financial positions or your balance sheet. And when I show an example of a balance sheet, you'll see that. They're essentially other uses for cash. So when I was talking about not having a balanced budget, if there's income left over in your annual budget from your revenue and expenses, then that um, those funds might be allocated to some capital expenditures, or they might be put into a savings account for a reserves budget. Um, and there also might be um, income from prior years that you have in your reserves budget, for example. Um, and or if you have a loan to repay, that's where that money will come from also. And then your cash budget is the cash flow. Oh, actually, you know what? I'm I'm gonna have Jan go to the next slide because I realize I have more detailed slides about these. So um, on each of these types of budgets. So your capital budget, these are your higher cost items. Also the funds for maintaining your capital items. So these are your fixed assets as opposed to your expenses. So these might be this might be equipment, furniture, vehicles, buildings, things that aren't used up in a year. Your capital budget would also include funds for maintaining items that are already on your capital list. And a capital budget could span a series of years. For example, maybe you have a goal to purchase a new computer for staff, one a year for the next 3 years. So that would be part of your capital budget to make sure that there is income coming in each year that could purchase one computer a year for 3 years. Um, it You still want to be revisiting and revising your capital budget in relation to your operations budget as they are integrally linked. Um, and you'd also want to have a capitalization policy, and I have sample that will be shared out, which is the dollar amount over which um, each an item, the dollar amount that you establish as being what will have an item be on your asset list versus being an expense item. And it's treated differently in your bookkeeping, particularly if you're keeping your books on an accrual basis. There are some IRS rules about that, but I'm not going to really dive into those. The next budget type that I want to just touch on is a contingency or reserves budget. So this is your rainy day fund, which could be for a variety of purposes. Um, it could be money that you are setting aside for unexpected events, for maybe something like a pandemic, or possibly something like an opportunity to grow your organization where you need to put a little cash out ahead of time. So basically, what you need to fund above and beyond your operating costs. There's no set amount that should be in your rainy day fund, but there's a recommendation to have 3 to 6 months worth of your regular expenses. So your rent, your payroll, and so on, so that if no money came in the door for, a couple of months, you could still cover all of your expenses. It wouldn't put you out of business. On the very low end, you at least would want to have 1 month of expenses and of payroll and rent, and certainly having 2 years worth of expenses in the bank, it would seem like that's maybe too much cash just sitting there not serving your mission. So that might be looked upon as being just sort of too much cash in the bank. You do want to replenish the fund if and when you use it and have a plan for that. So that would be part of your budgeting process um, to know that you were either putting money into your reserves or were replenishing money that you had to use or growing your reserves. And and so this gets incorporated into your budget cycle where you're reviewing and revising this annually to make sure that the reserves matches your organization's needs. Maybe you had decided how much would be perfect, would give you 3 months of expenses in your reserves fund, and you'd save that up, and 2 years have passed, and you've maybe doubled your staffing. Well, that money doesn't cover what it used to cover, and it's not enough for 3 months of expenses any longer. So just reviewing and revising annually allows you to make sure that what you have in reserves is covering what you expected. Next slide. I'm just going to take a sip of water here. So a cash budget or cash flow projection is looking at your revenue and expenses divided into months. So it's similar to what's happening in your bank register. When is money coming in? What's the timing of money coming in and the timing of money going out? Some of that you have control over, and some of that you don't. So you want to make sure and be watching that. Some amounts will be the same each month, let's say a rental expense, and some amounts will vary each month. If you have a very seasonal program offering, then you sort of know which months of the year you have more expenses, and you want to make sure you have cash to cover those expenses. There might be some timing of grants coming in, or there might be, I don't know, catering charges for your annual fundraiser. So there'll be the cash flow projection is a way for you to analyze when shortfalls are going to occur and make a plan for how to cover them. So when you've created your budget, your operating budget, then you also want to create a cash flow projection so you can just see, are you going to be fine month to month, or do you need to try to get cash in the door sooner or delay paying some expenses in order to not get into a situation where you don't have money in the bank to cover. And that might be a case where you draw on your reserves for 1 or 2 months, knowing you can replenish it in the following months when the cash flow has eased up. Next slide. So I want to move into talking about monitoring your finances and the budget, including financial statements, but I'm just going to pause for a minute, see if there are any questions. All right, so I am a big fan of reviewing financial statements regularly. Um, when you have your approved budget, maybe you have a function where you can add it into your bookkeeping system. You might do that. And so now what? So now you want to make sure you're also reviewing your financial statements regularly. And I'm just calling out a few of the main ones, but there are lots of different ways of looking at your financial statements, but the really most important and major ones are your statement of financial position, and I'll be showing you some examples. So that's also called the balance sheet. So this is the where your capital items and your loans that you owe are in your statement of financial position. Your statement of activities, which we also hear called profit loss statement or income statement. And this is what shows your income and your expenses and really follows what you've budgeted in your operating budget. There are comparative reports. Typically, it's a statement of activities, budget versus actuals. It could be looking at this year compared to last year, or looking at 3 years, or month to date for this year compared to month to date for last year, for example. And then there's your statement of cash flows, the cash flow projection that I was just talking about, which is a way to identify shortfalls and how to manage them. Next slide. So the statement of financial position, as it sounds, it depicts your financial position on a specific date. So the statement of financial position covers the organization's financial activities from yes, Janet, the slides will be shared. So you will have those to reference later. Um, yeah, it's a lot to write. So the balance sheet or the statement of financial position shows the activities of the organization from its inception to the current day. And it includes your assets, what you owe, what you own and what you were owed, your liabilities, what you owe to other people or other entities like a bank, and then your net assets, or which would be called, profit on a corporation's on a for-profit financial statements. And for nonprofits in particular, the IRS asks us to track our net assets in two categories: without restrictions and with restrictions, which could be further divided into temporary restrictions or permanent restrictions. And re- and I'm really talking about assets that are restricted by the donor. There are certainly times where a board wants to designate a certain amount of funds for a particular purpose, but that is not what we're talking about when we talk about these restrictions on that the IRS is interested that we are tracking. And the kinds of restrictions that we're talking about could be restriction of time. This particular money needs to be spent by this date. It could be purpose. This money needs to be spent for this particular program or to cover these particular kinds of expenses. Um, so those are the temporary restrictions, and then permanent restrictions is like an endowment, something that is perpetually restricted, meaning you can't actually spend the money at all. You could only spend the interest that that money earns for you, or for your organization, I should say. So let's go to the next slide. So here's a statement, a sample statement of financial position. Again, just sort of simplified. The assets are the top two sections, so what you own and what you're owed. Your current assets is anything that really can become cash in under a year. And then that's followed by your fixed assets, items that are harder to turn into cash. So your fixed assets can include your capital items that haven't been fully depreciated yet. And then below assets, you show your liabilities. So again, subdivided your current liabilities, what things need to be paid off within a year, and then, or a year or less, and then your longer term liabilities. What things are you paying off over a longer period of time? So that might be a loan that you have or a car payment, something like that. And then the final section is your assets minus your liabilities, equaling your net assets, shown without donor restrictions and with donor restrictions. Any questions about the statement of position before we move on to the statement of activities? All right, next slide. So the statement of activities depicts your activities over a period of time, which could be, you could look at a report for a month, it could be for a quarter, it could be for the year. Typically, it does include a full month. I haven't really seen any reason to look at a statement of activities that is sort of like mid-month or something like that. What do I mean by fixed assets that haven't depreciated yet? Okay, yeah, why don't we go back one slide to answer Elizabeth's question. So when you purchase larger cost items that are going to last longer than a year, such as a vehicle or a building or something like that, the IRS asks that you depreciate them. And what that means is you're spreading the expense of that item over the period of time that you will be using the item. So there are standard charts for depreciation, but for example, a vehicle might be depreciated over 7 years. So if you, just to make the math easy for myself, if you bought a $70,000 car that you're depreciating over 7 years, each year you will record an expense for 1/7, $10,000 of that total cost. So under this fixed assets section, you see the vehicles and equipment line followed by the accumulated depreciation. I did not put a sample depreciation schedule in this chart, but essentially that negative amount there will be an expense that shows up on that year's statement of activities so that the expenses of the organization are aligning better with what you are using over time at the organization. Did that answer your, that makes sense. Okay, phew, good. It is complicated and I thought about getting into having a depreciation, but it's basically, you're just aligning your expenses with your activities. If you need that car to provide, you're delivering food boxes or something, let's say you have a food bank, something like that, and you bought it one year, if your statement of activities showed that you spent 70,000, but you didn't provide more services that year, and then the next years you had less expenses, It's just a way of making sure that expense is showing up each year, that it's relevant to the activities of the organization. Okay, so let's go to the next slide, statement of activities. So again, these are over a period of time showing if there's a surplus or a deficit. Did you have more income than expenses or the other way around? The um, revenue will be categorized by donor type, like we looked at when talking about what to think about each of your revenue sources for the year. And the expenses might be reported by function, which will make more sense when we go to the next slide. Thank you, Jan. So here's a statement of activities. For just 1 minute, ignore the 3 columns off to the right, the ones that say management, programs, fundraising. The first 2 columns show the top section are your 2 revenue types, your contributed revenue and your earned revenue. And then the section below has your expenses, which in this example are divided into personnel, program, and office and general expenses. In the expense section, if your organization is of a size that you need to complete the full 990, the IRS asks that you report your expenses both in what they call the natural categories. So those are salaries, taxes, supplies, rent. Those are all your natural categories. And they want you to report them in the functional categories. So those are the next 3 columns. What were the expenses that had to do with management administration? So that's really your overhead sort of operations. What were the expenses for programs and what were the expenses for fundraising? So those are the 3 buckets, is how sometimes I call them, that the IRS asks you to report. In this example, I also divided the revenue into those 3 buckets. The IRS does not ask you to do that, but some organizations track their funding that way because perhaps they have um, donations that came in that are for a program only, then they want to show that income in the programs column. Um, and so that can certainly be helpful if you are running reports on a particular program that you know that the income came in for that program and the expenses for the program that they work together. Um, there are some, I think there used to be more sort of firm rules of thumb about, keep management and administration as low as possible and have the most of your expenses concentrated in programs. There's not really an exact rule of thumb. There are some um, suggestions out there. For example, on Charity Navigator, they say that if an organization has about 75% of their expenses go towards programs, they get a higher rating on Charity Navigator. And then that means 25% is for management, admin slash fundraising. Better Business Bureau says at least 65% for programs. Um, and, there's 2 things. One, we are nonprofits for the purpose of serving our mission. So our missions essentially is our programs, but also you do need overhead of some type in order to have a structure to support providing those programs. So um, uh, you really need to be spending in all those categories, I guess is the main thing that I want to say. Questions on the statement of activities before we move on to the next example? All right. So then there's looking at budget versus actuals, which is sort of the main type of comparative reports. It's really the most common type where you're looking at your actual revenue and expenses compared with your budgeted revenue and expenses. And then you're seeing what the difference is, over and under budget, um, both in a dollar amount and a percentage. And we'll see that in the example. And again, this is really a great tool for assessing your performance and then modifying or pivoting your plan as needed. Next slide. So here is an example of last year's budgeted amounts versus actual amount. And I was realizing as I was looking this over, I think most of us say budget versus actuals, but these reports typically include the actuals in the first column and the budgets in the second column. So just for what it's worth, I wanted to just say that. Um, so again, your revenue sources and your expense purposes. Um, the first column being what actually happened for January 2024 through December, what you had budgeted to have happen. The next column is the variance, or basically the difference between the budgeted versus actuals, and then the variance percentage. What percentage off of budget are you? Um, Under budget doesn't necessarily mean positive or negative. It really depends on if it's a revenue or an expense line. So, um, but it's great to have both the dollar amount and the percentage on this kind of report so that when you're looking at it with your board, nobody has to sort of do any math on the spot. They know what the dollar amount is and they know what the percentage difference is. Sometimes the dollar amount is more important to look at, and sometimes the percentage is more important to look at. So if you think about, um, I don't know that there's something on this example, but if you'd budgeted $300 for something, but you spent $600, just because you went 100% over on that line, it's maybe not that big a dollar amount in the scope of your entire budget. So the percentage isn't really that important, but you might want to know that you actually had under budgeted for that line. So next year you can budget more for paper clips or whatever that was. Um, you might be looking at a month by month budget versus actuals. You might be looking at year to date, or this is like a summary of the year past. In the next slide, this shows what a forecast might look like. Maybe you're two-thirds of the way through the year. Two-thirds, did I say that? Three-quarters of the way through the year. So January through September, what have you actually earned and spent? And what do you anticipate happening for the last quarter of the year, October through December? So in this example, your fourth quarter column is called out in red font, so it's clear that it's a forecast. And then you can look at the total forecast for the year versus what was budgeted. And again, looking at the variance, both as a dollar amount and a percentage. So that can be super helpful, particularly let's say when we get to um, when we get towards the end of the year and we're preparing to budget for the next year, we might want to forecast for the current year to use those numbers to help us budget for the next year. And Elizabeth, I don't think there isn't really a good percentage variance. Do you I guess ideally you're making all you're exceeding all your revenue goals and maybe you're spending less than you had budgeted for, so there's extra cash at the end of the year, but really depends on what you're working on, what opportunities came up during the year. So there's no really magic number. And they're never going to be, unless you're got some major crystal ball, there's always going to be a variance, right? You're always going to have, change in any of these lines. An unexpected donation comes in, you didn't know somebody, I don't know, left your organization in their will, and unfortunately they died that year or something, or your rent was increased mid-year, so you have to pay more for the rent because you can't move out of that space or something like that. Yes, so many variables. Absolutely. Which is why it's important to be tracking all the different categories you need to track, but not in so much detail that it makes the report unreadable for you and for your board members. Definitely. It's that balance between, just enough so that you can understand what's happening clearly. Yeah. So statement of cash flow. So this depicts the activities on a month by month basis. This is your cash flow projection, right? Showing a surplus or a deficit by month. And I need to get myself on my right slide here. So it really follows the order of the statement of activities with the revenues followed by the expenses. And bear with me with this example because I know it's a lot. No, go ahead, Jan. Yeah. So there's nothing, you don't really need to look at the numbers themselves, but you can see that in the left-hand column, you've have your contributed revenue, your earned revenue, and then your three different expense areas. You might have more, but that's just the sort of high-level view for this example. I'm going to stop there just for a minute. So those would correspond with your operating budget, right? What you had budgeted for the year for your revenue and your expenses. But then you have other uses for cash. You might have a note you have to pay. So that's what you see further down in the lower section. You might have some capital purchases. Maybe you have in your capital plan, you're going to be purchasing a big piece of equipment and a new cooler for your food bank or whatever it is. And maybe you have a really ambitious plan to um, add to your reserves. Maybe you haven't had a reserve. So that's what you see in the lower portion, the other uses for your cash. So the in the upper left under January is your beginning cash. So how much cash you had in the bank, just type that number in there. And then what you expect to come in month by month for your contributed revenue and your earned revenue. And then same what you expect to be spending each month. For some organizations, the expenses might be pretty consistent month by month through the year. And for other organizations, it might fluctuate a lot based on the activities of the organization. But if you go follow down the first column of numbers, January to the bottom, so the money that came in, the money that went out, the other uses that we have for cash, we have to pay our loan and we're putting some money in reserves. And what we have at the end, 194,000. We all hope we have that. And then you'll go back to the top of February. You'll see that's your starting balance. And again, so that's why they call this cash flow. The cash is flowing in and out, and then what's at the start of the next year or next month, sorry, and continuing through to the end of the year where we're going to end the year. Um, and uh, so, you want to look for in this forecast, are there any times where that ending cash is a negative number or just a number that's we're not comfortable with? What does that mean? Can we get some of the revenue in the door sooner? Can we delay paying some of the expenses? Do we maybe have to forego transferring to reserves for that particular month, but we're going to add it on later in the year and put more into reserves, whatever it is. So it helps you manage your cash flow. In the next example, um, So the prior one was a cash flow projection, so something you could generate from your annual budget that you've developed. And this is more of a forecast, how you would be looking at those numbers through the year. So let's say it's the end of September and we have all our bookkeeping done for the month. We know what money actually came in each month. So this could get, updated on a monthly basis or a quarterly basis. And then what do we forecast happening by the end of the year? So again, we can see where we started out, what's happening each month, including our other uses for cash at the bottom, and then where we're going to end up at the end of the year. Questions before we move to the next slide? And I just have a few more slides, by the way, and then time for other questions at the end, if there are any. And I'm happy to go back to any slides if that's helpful too. All right, so next slide. So just a reminder about reviewing your financial reports. It's just really great to get in the habit of reviewing them and training your board on reviewing them too. There are a couple of good overviews for boards that I'm including in the information to Maureen that she can share out in case it's helpful to you, a refresher or for one of your board members perhaps. Um, because our boards are made up of all kinds of people, right? They're not necessarily finance people, but it is their responsibility. They have fiduciary responsibility to the organization. So having some comfort level and some regular review of the statement of position, the statement of activity, budget versus actuals, looking at the cash flow, and then there might be other reports that are important and specific to your organization that you'll want to look at. Um, so next slide, really my final slide, just sort of reminders about um, through the process, assembling your team, creating the calendar, getting all your historic data and your assumptions together to prepare for the process, to develop the budget. You just want to take it one step at a time, but make sure you schedule time for each step, knowing that you also have other work that you're doing and the people on the team that are helping you are doing. If you routine the process and have kind of a regular system each year, it will become easier. It's great to plan for the unexpected, not that you can imagine what that's going to be, but you can certainly think about a reserves or a rainy day fund just as a buffer for hard times or an opportunity if an opportunity arises. Um, and monitor your budget and your financials regularly. So hopefully I took some mystery out of the process. If you had some mysteries in your mind about part of this, reminded you of what you already know, maybe gave you a couple of new tools, and there will be some templates and tools of things that I talked about that Maureen will share. And it really will get easier each year as you routine the process and you have historic data to reference. Um, so let's see. I think the next slide just asks if you have any questions. And the slide after that, we have a survey that we would love for you to take. I have a link that I'll send to Maureen, so you don't need to snap a picture of this QR code. But if you want to do that for those tech savvy people, it's just has 5 questions, something like that. Yes, there's definitely a budget Excel budget workbook that I'll share out that has a few different tabs, one for staff, one for revenue, and so on, so that that rolls up into a main workbook, and you can customize it for your to match your account lines in your chart of accounts. Yeah. So I think we could either stop screen sharing or maybe leave the slides up in case there are some questions that that anybody wants to go back to. So I'm happy to answer any question. Thank you, Jan.
Thank you so much, Susan, for another wonderful presentation.
Sure, my pleasure. I will include my email to Maureen. So, because sometimes we just need to kind of ruminate on things and then we realize, oh, right, I wanted to ask about XYZ, then just shoot me an email and I'll be happy to answer if I know the answer or direct you to another resource for that. So we finished a little bit early. I just want to give it a couple more pauses for any questions anyone has. All right. I'm not under the illusion that I was so thorough and clear about everything, but I appreciate all of you taking the time to be here. And again, when Maureen has things together and has the information from me, she'll send that out. And Maureen, do you want to add anything, or Jan?
I will be sure to send out a copy of this recording as well as links to our nonprofit services page and a few upcoming events. One thing I did forget to highlight, our grant cycle will be opening up in July, and we will be hosting an informational webinar in July like usual, so keep your eyes out for more information about that soon. Thank you again so much, Susan and Jan and Christine from Snow Isle. It's always such a pleasure to get to put on these workshops with y'all.
Thank you for the opportunity. Appreciate it. Good to see you all.
Thanks for your time.
Thank you.